Well, thank you for taking time out of your schedule to join us. This is a webinar on demand from Vision Advisors. This is John Terry, the Chief Marketing Officer. Thank you again for just taking time to jump into another session of our Vision Virtual Sales Academy. You know, one of the things we want to do at Vision is not just to be known for great product, which every IMO's got great product. We want to be known for bringing innovative ideas and opportunities to you to figure out how to take the products that you've got in your toolbox and the additional products that we can bring to bear and use those to help your clients see financial success. I was recently having a conversation with one of our good friends and somebody you've heard on previous episodes of some of the webinars we've done here at Vision, Mr. Mike Zimmeretti from National Life Group, and we were talking about a very interesting play in the tax code under Section 199A. Mike shared some intel with me that I thought was just exciting, and as a result of that, I asked him if we could set up this call today where we could actually go through and talk about how Section 199 can create some very unique opportunities working with a very specific type of client. Many of you on this call may already be working with these individuals on a personal level, but you may not realize there's some opportunities on the other side of the equation that can allow you to go a little bit deeper with the client than what you're doing now. So, Big Mike, I want to thank you for taking time to be with us on this call today. We always appreciate an opportunity to hear from you. So if you'd like to kind of set the stage and introduce our guest speaker for the day, I'll flip it over to you and away we go.
Well, thank you, John. It's always a pleasure to work with Vision Advisors, and I really applaud the educational aspect that you have been embracing. So I'm really proud and excited to be here today to talk about a niche that I think many of you will look at as a tremendous opportunity. In our day-to-day planning activities, when we meet potential clients, there is a host or a ton of competition out there. Whereas in this, what we're going to discuss today, it's a very finite niche market that has tremendous opportunity that only 2 or 3 insurance carriers are really involved with. And as you'll find out, National Life leads the way, as we usually do, in our opportunity offering. So 2020, a year of opportunity and challenge, new compliance, new suitability, new tax code. But I've been doing this for 30 years. And every time there's change, we find a opportunity, the golden egg that is in this, the needle in the haystack that turns lemons into lemonade. And what you're going to hear today is spectacular information, which I want you to think about as you listen to the gentleman I'm going to introduce you to. This will not only give you the opportunity if you work with small business owners, but it is going to give you the opportunity and direction to, if you're not working with business owners, to perhaps target them as an opportunity, and secondarily, a tremendous opportunity to network with CPAs and tax accountants, because this is very relevant information. And anytime you can go to them, because let's face it, they get hit on all the time by different agents and insurance entities looking to partner with them and share their book of business, so to speak, but they really never have an objective story. In this case, we can go in and discuss tax leverage, we can discuss the need for life insurance and be able to do it in a deductible fashion, and we can talk about our incredible living benefit story that is going to be tied to all this, and we'll get into that down the road. As I've mentioned in previous WebExes, the National Life Group is 171 years young, and among the many resources we have is a robust sales desk, but a specific advanced sales desk manned by advanced sales experts and attorneys. And then we also have a qualified plans sales desk that is an adjunct to the advanced sales. So today, I am going to turn this presentation over to an amazing person, and he is going to, Brian is the lead on the advanced sales desk, Mr. Brian Pritchard, and he's located in Montpelier, Vermont. So Brian, please feel free to enlighten us.
Thank you, Mike. Thank you, John, for the introduction. As mentioned, my name is Brian Pritchard. I am one of the members of the advanced markets team here with the National Life Group. And today what we will be discussing and the opportunity that I will be broaching with all of you is something that's been out there now for about a year or two, but it's still very underutilized in the CPA market when working with our business owner clients. And that is the concept, or I should say the tax code section known as Section 199A. And what we're going to be talking about during this presentation is essentially an overview of how this new code section 199A and qualified plans can interact with each other to help turn our tax losers into tax winners. So when we talk about the opportunities that the 199A is going to be bringing to the table, what we're ultimately talking about is the ability for pass-through business owners. That's LLCs, LLPs, S-corps, partnerships, you name it. The various pass-through entities, the ability to generate an additional tax deduction for them. And when I say an additional tax deduction, what I'm talking about is an additional 20% off of what is known as their qualified business income at the end of the year. So if you don't have a great relationship at the moment with business owner clients or CPAs, by getting a better understanding of this 199A concept may help open the door to new opportunities and ultimately help you enter the realm of the business owner marketplace. It is important to know that as a result of the Tax Cuts and Job Acts that was put into place a few years ago by President Trump, that these provisions that we will be talking about currently have a sunset date of January of 2026. So what I always recommend everyone to do in these type of situations is when there is an opportunity out there, especially when we know it's an opportunity that is not going to be there forever, we want to take full advantage of it while the time allows. So now is the time to really have those conversations, especially as we know business owners and their CPAs are at the end of the year, they start looking at those books to really figure out what type of tax scenario they'll be facing. And that's unfortunately when that light bulb moment goes off. So now is a great time to start these conversations. But before we get into the nitty-gritty of what Section 199A is and how it interplays with qualified plans and our business owner clients, there are a couple terms that we're going to need to have a better understanding of in order to really dive into the details, if you will, of this 199A concept. So the first thing we'll need to understand is what is a specified service business. And when we talk about specified service businesses, what it is referencing is any business where the main asset or principal asset of that business is the reputation and or skill of one or more of its employees or owners of the business. So perfect examples of this would be individuals in the health industry, law, accountants, actuaries, consultants, athletes, folks of this nature where the primary asset of that business is truly the reputation of the individual or one of the individuals within that business. A couple other important terms that we're going to need to understand before we will be able to truly dive into this presentation are the three that you see on the screen here. The first, taxable income, which speaks to all of the taxable income on a taxpayer's personal return, including that of their spouse, even when the income from the spouse may not come from the owner's business. So regardless of if you're the owner of a business and your spouse works elsewhere, when we talk about taxable income, we're talking about the total income that is included on that taxpayer's personal return, including the spouse. Qualified business income, as you can see, that's defined as the net amount of qualified income, gain, deduction, and loss with respect to the qualified trade or business of the taxpayer. In a nutshell, think of that essentially as the net income that would ultimately pass through in one of these scenarios for our business owner clients. So qualified business income, I like to reference more as net income, but you'll see we reference it as QBI for these individuals. The last one is the most straightforward of these terms, simply the W-2 wages paid to employees. That's important in these calculations to determine the 199A deduction that may be available. And when we talk about what we mean by W-2 wages paid, that's going to include all of the W-2 wages being paid out, including any W-2 paid to the owner as compensation. So now that we have a good general understanding of the terminology that I was referencing earlier, as you can see on this flow chart, you'll see kind of all of these various terms: specified service business, qualified business income or QBI, taxable income, as well as that concept of W-2 wages paid. Now, when you first look at this flow chart, I'm sure it's a bit overwhelming, if you will, but I want you to really kind of take a step back and look at it from a different vantage point, because you'll notice at the top in the center of this flow chart, there's really one question that needs to be asked, and that's going to ultimately determine whether we take a left or we take a right in terms of determining which side of the flow chart will go down, and that's whether or not you're the owner of a specified service business, which again, if we remember from our terminology just a minute ago, is just essentially asking whether or not you own a business where the main asset of the business is the reputation of one of the individuals or the skills of one of the individuals at that business. And again, depending whether we are a specified service business or not, will determine whether we take a left or we take a right, where ultimately the flow chart begins to look a lot easier and a lot more digestible from an understanding. So as we do this, ultimately, as I mentioned kind of a little bit earlier when we started the overall conversation here, is that what we are ultimately going to be doing with our business owners, because we know that they're facing a number of challenges, whether it's an individual, family, or the business itself, determining whether the tax winner or loser often depends on these various tax laws and how they're able to navigate them. So in this case, our goal for you and everyone out there from an opportunity standpoint is for you to be able to identify a business owner that is currently a tax loser and help us turn them into a tax winner. Now, in order to do that, as I mentioned earlier, we've discovered that there's a delicate balance between this idea of a 199A deduction and the opportunities available to help reduce their current taxes and help them save for retirement. The way we'll be doing that is a combination of a couple of things, but mainly leveraging that 199A deduction and integrating a qualified plan as a strategy to help maximize those tax savings. So the first thing I want to do is I'm going to show you two different examples. But the first example that we're going to ultimately be going through is one that covers what it would be like for a specified service business and ultimately show you how we can help, again, turn them or turn that tax loser into a potential tax winner. So in this case, we have a business owner, in this case, named Sylvia. Sylvia is currently the owner of an S corporation. She's married and filing jointly. And as a business owner, she and her family like to live a relatively luxurious lifestyle. They like to have, as you can see on the screen, a little over $225,000 of after-tax cash flow on an annual basis. That's what they like to live off of. Now, these assumptions that you see on the screen here also coincide with Sylvia's business, which shows that she has a $500,000 net business income that she's currently generating as the single shareholder of her S corporation. So when we look at these assumptions, what you'll see is that Sylvia's $500,000 of income can be broken down into a combination of two things. $200,000 that she pays herself in the form of W-2 income, and $300,000 that she would be taking in the form of a K-1 distribution, which is essentially what we'd know as that pass-through income. Now, when we think about how this is going to ultimately interplay with Sylvia and what this could ultimately mean from a tax standpoint, well, we know that, as we said earlier, Sylvia is a specified service business owner. Based on our assumptions, her $500,000 of taxable family income, we also know that she's currently over this $421,400 taxable income threshold. So as you can see, we've broken down a little bit on the right here, a piece of the flow chart that we were looking at earlier. And ultimately, as a result of her $500,000 of taxable income, she's currently would receive a $0 deduction from the 199A, from Section 199A. So if Sylvia were to file her taxes and do absolutely nothing different than what she's looking at today, she would have $500,000 of income, taxable income, $200 in the form of W-2 wages, $300 in the form of qualified business income, right? That's our QBI. We have no defined benefit plan in place, so she's receiving no deduction or contribution there. No 199A deduction as a result of that taxable income exceeding $421,000, which ultimately means at the end of the day, if Sylvia did absolutely nothing, she would be looking at paying $126,000 in taxes and having $373,000 in change going to work for her today in the form of savings. Now, that's great, but as Sylvia tells us, she wants to increase her savings and decrease her taxes. So the idea here is the ability to leverage and layer on what's known as a qualified plan, and in this case, specifically, we'll be talking about a 412E3 defined benefit plan. Based on Sylvia's age and her W-2 wages of $200,000, we're looking at the possibility of putting in a 412E3 that would generate $200,000 worth of contributions. What would that do from a tax standpoint, if you will? Well, her taxable family income would be reduced from $500,000 down to $300,000 because we were able to deduct the $200,000 being contributed to the qualified plan, which also would in turn reduce Sylvia's qualified business income from $300,000 to $100,000. She still wants to have a nice chunk of change for, an after-tax cash flow basis, but let's just take a look and see what adding on this defined benefit plan might do. The first thing that's important to know is simply what does the 412E3 plan look like from a retirement standpoint, and what do these pre-tax contributions ultimately go towards? Well, what you can see here is based on her age and salary average, we can put together a $200,000 contribution to a 412E3, including a life insurance contract inside of that. So this plan is funded entirely with life insurance and an annuity. Ultimately, when she retires at age 62, these plans, after contributing $200,000 on an annual basis, would provide her with just under $7,000 per month at retirement if she wanted to annuitize her contracts. Or she could be looking at a lump sum of a little over $1.8 million. But of equal importance is that we're able to generate a $2.1 million whole life policy on Sylvia's life to self-complete her retirement plan in the event that something were to happen to her prematurely, so that not only are her loved ones protected in the event something goes wrong so that they can get that death benefit claim, but also the accumulation aspect of this will set her and her family up for a secure retirement by age 62. So we know what the qualified plan now looks like, but what impact from a 199A deduction and a tax deduction does this ultimately have on our client? Well, as I mentioned earlier, our taxable family income and qualified business income both were reduced by $200,000. So does that get us under the $420,000 threshold? Well, we know it does. So let's take a look now and see what we'd be looking at. So we still obviously own a specified service business. Our taxable income is well beneath the threshold. And as a result, what you'll notice is that our 199A deduction has now allowed us to take 20% off of our $100,000, ultimately resolving in a $20,000 199A deduction. So what did that qualified plan ultimately accomplish above and beyond retirement savings? Well, let's take a look at a little bit of a comparison of what our do-nothing strategy on the left versus our tax planning with a defined benefit plan on the right has done for Sylvia and her business. Well, we see taxable income decreased, W-2 wages stayed the same, qualified business income decreased, our defined benefit contribution of $200,000 is how we were able to get those original deductions, but notice it also helped us generate a $20,000 199A deduction. So what does that ultimately mean in the grand scheme of things? Well, when Sylvia requested us to help her increase how much money is going to work for her today, while simultaneously helping her save on taxes, our 412E3 solution has ultimately allowed us to accomplish that by putting more money to work for her today and getting a deduction for our qualified plan, as well as a 199A deduction to ultimately help save about $70,000 of addition in taxes. So that's pretty powerful. We were able to more than cut the amount of taxes that Sylvia owed in half by layering on a qualified plan, and in this case specifically the 412E3 solution. Now, sometimes maybe the $200,000, maybe that's too much. Sylvia said, you know what, I really like the idea, I like the concept, but $200,000 being committed to the qualified plan, that's a little rich for me. So what if we were to decrease it a little bit and only do $100,000 into this qualified plan? Well, if we decreased it to that amount, as you can see, our 412E3 benefits have more or less been cut right in half, still getting a healthy monthly benefit at retirement to help supplement and or live off of, a healthy insurance death benefit in the event that something were to happen to Sylvia prematurely to help self-complete the plan, and ultimately giving her the option of having upwards of $954,000 in qualified assets at age 62 when she retires. So again, let's just take a quick look at what that does from a tax planning standpoint, because now recognize that we have only reduced by our $100,000 412E3 benefit. So our family income is now at the $400,000 mark and our qualified business income at $200,000, which means we have over $321,000 of income, but we're not over the $420,000. So we're in this nice, interesting, what they call a phase-out deduction. So we're going to get something for our 199A deduction, but we're not going to get the entirety of it because of this phase-out, which means in addition to the $100,000 that we contribute to the qualified plan, we're now able to generate an additional $6,000 of tax savings in the form of a deduction from a Section 199A plan. So now let's again take a look at what this would look like. If we compare it to Sylvia's original do-nothing tax savings plan, our taxable income is slightly reduced, our wages are the same, our qualified business income was reduced, we have our $100,000 DB or 412E3 contribution, and again, because of this, we're able to save an additional $6,000 from a 199A deduction, which basically boils down to the fact that we're able to decrease our income tax, increase the amount of current money that's going to work for us. So again, we were able to accomplish Sylvia's goals by layering on that 412E3 defined benefit plan.
And still putting money aside for future retirement, correct?
You got it absolutely correct, John. The key here is that
that's a win-win-win. I mean, really, if you look at that across the board, Who wouldn't want to do that if they saw this as an opportunity?
Absolutely. The ability to set money aside for retirement through our qualified plan and defined benefit plan 412E3 combines that deduction right off the top and that retirement savings with the ability to lower our qualified business income and our taxable income, which helps us navigate into that wonderful world of 199A, where we get what I like to say the cherry on top of an additional deduction, essentially for already doing something that's going to help us plan for retirement and save us on taxes today. That's a double dip. That's the cherry on top. That's whatever you like to call it. But that's ultimately what we're trying to show you, is the ability to turn this individual who was a tax loser, had no deductions, no qualified plan contributions, no saving for retirement, to ultimately help them navigate in a way that's going to help them set them up for not only a more efficient tax savings today, but ultimately a more efficient qualified plan and retirement savings later on. So that's what it looks like if we were to take, if you remember the flow chart well, if we took a right and we said, yes, we are a specified service business. Now what I want to show you is a non-specified service business example where we're doing something very similar with our qualified plan, but ultimately navigating a slightly different world with a slightly different business owner. Important to remember in all of these scenarios that I'm going to be talking about is these are these pass-through business owners. So it's not going to be for the C Corp, but our S Corp, our LLCs, our partnerships, those are our business owner or business entities where our opportunity is ultimately going to be living at the moment. So when we take a look at what we now like to reference, before we were talking Sylvia, who was our specified service business, now we're working with Dan. Dan owns a retail store. A retail store from a primary asset, let me rephrase that. The primary asset of a retail store is not the reputation of the owner or of the workers, right? It's of the clothing, or it's of whatever it is that we're ultimately selling. It's our gear, it's our equipment, it's our merchandise. That's why we're ultimately a non-specified service business. So for Dan, who's married filing jointly, he is again similar to Sylvia in the fact that he owns an S Corp. And he also has, a family that likes to have a nice little chunk of change because they like to have a nice lifestyle on the side. Dan here is bringing in a nice, cool $1 million per year in revenue. Of that Dan's bringing in, $860,000 of that is coming in the form of taxable income back to himself and his family. He's paying himself $100,000 in the form of W-2 and taking in $760,000 in that pass-through business income, which is that distribution. In addition to the wages he pays himself, he also has a couple of employees that help him run this retail store, and he pays those employees $140,000 in W-2. So important to recognize in this case that Dan has a little bit of extra money going on because he has employees that he's working with in the form that he pays W-2, in addition to what he's doing for himself and his family. When we talk about Dan and what he would be looking at from a current do-nothing scenario, if you will, well, let's kind of go through those same facts. Remember, those three things we always got to remember. Taxable family income, that's our total income on the tax that we file on our tax. Qualified business income, that's the money being passed through from the business to the individual. And then our total W-2 wages that's being paid out to not only our employees, but also to Dan. So in this case, that total taxable income, $860, our QBI, $760, and total wages of $240. So for Dan, we don't own a specified service business, or Dan does not own a specified service business. And his income does exceed his taxable income over that 421 threshold, which ultimately means his deduction, a little bit more convoluted for me to actually wordsmith this, but ultimately comes down to one of these three different calculations, either qualified business income times 20%, or the greater of the W-2 wages times some of his unadjusted basis. But ultimately, for the sake of simplicity in this conversation, what we'll be talking about, and you can see the analysis here over the left, because whenever it's the lesser of this and the greater of that, as you can see, it's probably easier for you to just look at the screen here for a moment. But ultimately, what you're able to see is that the greater of his two W-2 calculations down here at the bottom is the 120 is greater than the 60. So we cross out our 60,000 because there was no unadjusted basis. So now it's the lesser of his QBI times 20%, which we see as 152,000, or his W-2 wages times 50%, the $120. Obviously, the $120 is lower than our $152,000. Hopefully, no one's already nauseous from the math that we just did here. But ultimately, what this slide is here to show you is that even in this case, if Dan were to do nothing for our non-specified service business owners, he'd be getting $120,000 of a deduction. So what does that look like? Well, as we saw with Sylvia, but in this case now we're looking at Dan's finances, we're basically able to save Dan, or excuse me, Dan is basically in the scenario where he's able to get $120,000 in a 199A deduction, which means he's paying a little over $213,000 in taxes, has a nice chunk of change, $526,000 plus going to work for him. But just like Sylvia, Dan's question or his ask of you as his advisor is, help me increase my savings and help me increase my deductions. Well, we have a solution for that. And that again could be something like a defined benefit plan. In this case, we're able to put together a defined benefit plan that has in the ballpark of, as you can see here, $225,000 from a tax deductible contribution standpoint. In this case, as we mentioned, there are a couple of different employees. So you'll see that of the total contribution, even though we have all of these employees, Dan is still able to get 88% or 88 cents for every dollar that he puts into the qualified plan, while still saving for, again, a nice healthy retirement and providing himself with $2.3 million of whole life insurance coverage. That's a powerful thing to be able to present to that business owner client. Not only can I potentially help you save on taxes through these deductions, but I'm able to help you buy insurance on a pre-tax basis to once again self-complete the plan in the event something were to happen to Dan prematurely. So when we look at this scenario, we now have two different options. We have the scenario where Dan did nothing and where we layered on our defined benefit plan. What you'll notice is that we're able to decrease Dan's taxable income and his qualified business income and increase a substantial amount our defined benefit contribution. And you'll notice the 199A deduction actually in this case has decreased. Now, a lot of you out there might be saying, well, why would I want to do something where I'm going to decrease our 199A deduction? And that's a fair question. But when you think about the fact that what we're doing is combining our 199A deduction with our defined benefit plan deduction, we're now able to save Dan from his $213,000 in taxes due to $135,000 in taxes. Again, that's about $80,000 less. That's more than a third of Dan's taxes that we're able to once again chop off by helping layer on this qualified plan and defined benefit plan solution. So based on his objectives and his ask, you wanted additional deductions and retirement savings, and that's exactly what that qualified plan was able to provide. Additional deductions and additional retirement savings for him. Now, that sounds great, right? And we really like that. Dan was he's a big fan of ours. We got him more savings. We lowered his tax burden. Loves what we're doing. So when we came back to Dan and we said, we know you liked what you saw that first time, but let me just show you another opportunity within this realm that might be even more advantageous for you and your family. And what that is in this case, we've actually added Dan's wife, Dora, to the business. Dan's wife, Dora, joined the business. She's going to help him on the books, and we're going to pay her $75,000 in W-2 in wages. So what this has ultimately done, while Dan also, by the way, has increased his own W-2 income from the $100,000 to $225,000, ultimately now turning what was, let me go back 2 seconds, what was $100,000 in W-2 and $760,000 in distributions to $300,000 in W-2 plus $560,000 in distributions for Dan and his wife, not to mention what our employees are getting. Well, now that's helped us increase the amount that we can contribute to our qualified plan, defined benefit plan, reduced our taxable family income, reduced our qualified plan, or excuse me, our qualified business income substantially, while still allowing the after-tax cash flow that Dan and his family like to live off of. So now that we've established, let's take a look at really what this combination of, once again, annuities and life insurance has done for them. Well, now what it's done is instead of 200,000 plus of contributions, we're now in excess of $480,000 of contributions. And instead of 88% going to Dan, we now have 94% of every penny being contributed going to Dan and his wife, providing coverage for Dan and Dora, and ultimately increasing the amount of money that they'll have in retirement. So once again, what does that do from a deduction standpoint? Well, now we have Dan, what we call within the phase-in from the deduction, because our qualified business income and taxable income decreased by so much. So we once again have actually, believe it or not, decreased our 199A deduction, and now we're at about $15,000. But what does that do to the plan? Because remember, we got to look at this from an overall tax planning standpoint to see what it ultimately does from an impact standpoint. And if we look at our do nothing in comparison to our, what we'll call the second version of our defined benefit plan design, you'll notice taxable income and QBI have seriously decreased. Our defined benefit contribution is almost up to now $500,000. As I mentioned, it did decrease our 199A deduction pretty substantially, but when you couple these together, our defined benefit deduction with our 199A deduction, you'll notice we're saving a lot more in taxes and got even more to work for us today. So let's look at these three versions. Dan's original state is do nothing, which was not horrible, but he wanted additional deductions and retirement savings. So when we implemented our defined benefit plan, that's exactly what we did. Got him additional deductions and additional retirement savings through our qualified plan via life insurance and annuities. But was that the best we could do? No. When we added his spouse, Dora, and increased his income, his W-2 income, we now have essentially from his do nothing phase, have essentially decreased his tax savings, or excuse me, have decreased his tax burden by $140,000 in the ballpark of. So we've almost cut it in a third, or 2/3, excuse me. And our money going to work for us today has increased by over $200,000. So I would say, would Dan ask me as a planner, how can I increase our deductions and increase retirement savings? The intersection of 199A and qualified plans sure seems to be doing a heck of a job. And it's important to know when we do these and we look at the numbers and you have these conversations with business owners that you look at more than just the numbers and you really do the full planning. Because as we saw early on when in the scenario with Dan, sometimes the 199A deduction on its own can be beneficial. But when we're looking for additional savings and additional deductions, sometimes the combination of these two will ultimately provide the best of both worlds and ultimately really allow the individual, to save as much as possible in taxes today, while also maximizing the amount that we're able to save in the future in our qualified plan to protect those and have that retirement nest egg that we know we want so that we can have a safe, secure retirement. And that's ultimately what we're looking to do here when we talk about qualified plans and our 199A deduction is how can we help these individuals maximize our tax savings and maximize their retirement savings to find that happy middle ground.
So Brian, let me jump in and ask you a question right here if you don't mind.
Absolutely.
I've got a producer that's had an opportunity to listen to this webinar on demand. They've got a client they think could be a candidate for this. What information do they need to provide to Vision advisors that we in turn can share with the advanced planning team there at National Life Group to be able to do the analysis to determine if a 199A opportunity exists and how to maximize that? What do they need to deliver to us to help you with that?
It's a great question. So ultimately, the information that we would need really revolves around, to an extent, the census of their business, the individuals that are working there, as you can see from, let's just go back for a second, I can show you some of the info right here on the screen. A lot of this is the general info that we need. We need information about the business, the employees that are there, their ages, their salary average, their dates of hire, things of that nature, just a general census. And ultimately what we would want to know is how much income they're taking in the form of both, if they're a pass-through entity like an Escort, in the form of W-2 compensation, which should be provided in the salary average, as well as what type of qualified business income or pass-through income do they currently have that they're working with. If you provide us with that information, and the way that we prefer to have it, is through what we call our qualified plan fact finder that provides that information as an addition to things like how does the business ultimately file their taxes? What type of business entity are there? Do they currently have a qualified plan? Based on that information right there and ultimately what the objectives of the individual are, we can help not only tell you and take a look at it from a 199A standpoint, but we can also help design the qualified plan that would be most appropriate based on the objectives provided to us.
Fantastic. Well, I want to thank you for taking time to walk through this for our producers. This is an area of the tax code that I'm sure many that are having an opportunity to watch this for the first time, or maybe they're going back through and watching it for a second time just to make sure they've got it right. This is something new in terms of exposing them to a different section of the tax code that maybe they didn't think about being able to utilize. I mean, how many of you on the call that are listening to this have clients that work with a pass-through entity? They're an Escort, they're an LLC, they're a partnership. And you've got an opportunity now to bring to these individuals that are making some sizable income in their business, but looking for an opportunity to leverage dollars so they reduce the amount of money they're paying to Uncle Sam, create an opportunity to save more dollars for their future retirement, and at the same time have the opportunity to increase their net income at the end of the year. This is one of those win-win-win opportunities I think is powerful. And if you've not had an opportunity to think through this, I want to encourage you to think through that to us. Brian, do you or Michael have anything y'all want to share as we get ready to wrap this call up?
Yeah, absolutely. The last thing that I would say, that I feel is vital to any of these cases, well, there's two things that I'll say. The first is ultimately when we're talking numbers with our business owner clients in this fashion, a lot of the times they'll be reliant on their centers of influence, CPAs and accountants. So if you're able to have this conversation with those individuals as well and get them on board early on in the process, it'll absolutely help you in the long run in terms of closing these type of opportunities.
Yeah, that's great.
I also want to, I also want to encourage you, if you don't have a lot of business owner clients, but you have an accounting or CPA relationship, this may be something that they are aware of, but do not truly understand the intricacies and the different avenues that can be explored with the 199A deduction and how it can be intersected and combined with these qualified plans as I showed. So I think it's a really great opportunity to have that conversation, not only with your business owner clients and their CPAs, but also just with the CPAs and accountants out there so that you can show the value that you can add to those practices to help earn their trust and respect, and hopefully some clients and referrals from those individuals as well.
Absolutely. And for those of you that are on the call, let me mention that we have a number of handouts that we can provide to you in terms of some PDFs and some educational pieces that you can pass on to your CPAs and your tax professionals that you're working with, as well as those individual clients that may meet the criteria that we're talking about. So we've got a number of resources that National Life Group has provided to us that we are more than happy to share with you to help you start the conversation. Big Mike, are you still with us, my friend?
Yes, sir. And I wanted to conclude with a comment. In my 30-year career, it's kind of on the entertaining side. I'll never forget when I was an agent in the field, and one of my fellow colleagues came to a meeting in the agency and was very frustrated and said, you know, it's really hard to sell life insurance out there or even have that conversation with people. People hate talking about life insurance. And everybody, I'll never forget, they laughed. And one of our most successful senior VPs said, Bob, people don't hate life insurance. What they hate is paying for it. And everybody laughed. And I kind of, through the whole presentation that Brian just did, I was smiling because not only are you providing tax leverage that everyone pays attention to, this really gives your clients the opportunity to say, you know, I'm killing two birds with one stone. I am using this money to fund my retirement and provide for efficient life insurance. And I've taken a lot of the pain out of it. So I thought it brought a chuckle with me, and I thought I'd share that with all of you today.
Absolutely. Well, ladies and gentlemen, if you've got questions related to what you saw on this webinar, 199A and the 412E, by the way, we are going to come back and do a follow-up training on 412E plans. So you're going to have an opportunity to see what those look like and how they work. So we'll be asking Brian to come back and share that with us again in a future Sales Academy update. So stay tuned for that. But if you do have questions, our number here is 1-800-505-8489. Again, 1-800-505-8489. Please feel free to give me a call or ask for Melissa or Gary. We'll be happy to answer your questions, get you the tools and information that you need to get in front of your CPAs, your tax professionals, and your clients that may be a candidate for this and help you start the conversation. So on behalf of National Life Group, our great relationship there, and all of us here at Vision Advisors, thanks for joining us and have a great day.
Thanks, everyone.